Are lower interest rates potentially a double-edged sword? On one hand, we're glad to see them because our cost of borrowing for car loans and mortgages are going down. But on the other hand, are they a signal that we're either in a recession or headed that way? Well, we might be. And that's why I made this video. I want to share with you some of the data that the Federal Open Markets Committee, which is our central bank, what they're seeing that's driving them and the rest of the central banks around the world to start lowering rates. What's causing this? So let's jump in. At the end of the video, I'll share with you, more importantly, what all of this means to us and what we can do to protect ourselves. So first, what the central banks of the world are seeing is the economy starting to slow. They're starting to see unemployment increase. And there's a rule called the Sahm rule that was developed by Claudia Sahm that says as unemployment ticks up, as it increases by 0.5 percentage point, it's been a good indicator that you're already in a recession. It's not necessarily a leading indicator, but it's an early indicator that we're already there. And this chart here shows what that looks like. And the Sahm rule has been triggered. And this is an image of Claudia Sahm. And she has a newsletter. And in that newsletter, she describes what's going on with unemployment and how predictive or non-predictive her rule might be this time around. And her blog post is called Something More on the Sahm Rule. A little bit of a play on words there. So before we get into her blog post where she explains where we are in the economic cycle, I want to share why rate cuts might be a bad thing. So we talked about unemployment starting to tick up, the economy starting to slow, but why rate cuts might be a signal of bad things to come. So this is a report by Business Insider, and the title is Sell the First Rate Cut. Bank of America's top global strategist warns stock could be in for trouble as the economy heads towards a hard landing and the Fed gets set to slash rates. So this is Bank of America's analyst by the name of Michael Hartnett. Michael's a smart guy. And he says that in the past, rate cutting cycles have shown that stocks fall during a hard landing. And the recession risk, he goes on to say, he thinks that people are underappreciating the risk of a coming recession. So let's look at this. Here's a chart from Hartnett's study, and he shows past rate cuts. And when rate cuts go up and go up fairly quickly and dramatically, it's been a signal of tough recessions. You can see in the 2008-2009 recession. You can see during COVID, May 20th, there were 92 rate cuts around the world. So this is not just the U.S. Central Bank. And as of July of 2024, there had been 35 rate cuts. And in that chart, not yet the Federal Open Markets Committee, the U.S.'s central bank's rate cut. And Hartnett goes on to say that, unfortunately, the professional money managers are just assigning an 11% chance of a recession coming in the next 12 months. And I don't know about you, but I think the odds are quite a bit higher than that. I don't think they're 90%, but I do think they're maybe 30%, maybe 40% of a recession in the next 12 months. And there's plenty of other smart bankers, including Jamie Dimon, who heads up JP Morgan Chase, which is the largest bank in the United States. So when professional money managers are not keeping up on the odds of a potential recession, when they're more optimistic than maybe what the data is showing, that can be a bad thing because it can leave prices higher for long. And when that does adjust, if it does, the drop can be harder, and it can happen over a shorter period of time. There's a saying in my industry that the stock market takes the stairs up. It takes a while for the stock market to increase in price, but it takes the elevator down. And in other words, the prices can come down a lot more quickly. Okay. The other thing Michael Hartnett at Bank of America talks about is just the performance. He says that the S&P 500 was up by almost a third, 32%, for the 9 months leading into the end of July. And in past recessions, it had just been up 2%. leading into those recessions. So getting back to that further to drop and more quickly to drop. Okay, talking about Claudia Sahm, who we talked about at the beginning, CNBC has an article. It says the Sahm Rule founder says the U.S. is not right now in a recession, but the risks are rising. And she goes on to say, we're not in a recession, contrary to the historic signal of the Sahm Rule. As I said, the Sahm Rule has been triggered, but the momentum is in that direction. And she goes on to say a recession is not inevitable, and there's a substantial scope to reduce interest rates. She goes on to explain the rule, and she said, however, the Sahm Rule in this Substack post that we're going to go over in just a minute, it's likely overstating the labor market's weakening due to unusual shifts in the supply chain caused by the pandemic and immigration. So while the Sahm Rule has a really good track record in the past, what she's saying is this time might be different. And it's the creator of the rule that's saying that. And she's saying it might be different because of shifts in the labor supply caused by the pandemic and also immigration. Okay, so now let's go to that. Something more on the Sahm Rule. And the subtitle on this is, the rise in the unemployment rate has raised concerns about the possibility of a recession, but the story is not as simple as the usual rules of thumb. I really like that because I think rules of thumb are useful, but we shouldn't take them as gospel, and we certainly shouldn't make big, important rules based on rules of thumb. They're good for high-level, broad guidance, but not so good when it comes to particular situations and specific decisions. Okay, her high-level takeaways is that a recession is not imminent, and that the Sahm Rule, I like this quote as well, the Sahm Rule is likely overstating the labor market's weakening due to unusual shifts in the labor supply. We talked about that one earlier. And the risk of a substantial weakening or a recession in the next several months is elevated, adding to the case for the Fed to begin raising rates. Now, one thing people have said is, because this rise off of the bottom, this is the unemployment rate, and so lower would be better in many ways. But you can see it's starting to tick up. People are losing jobs. And she goes on to say that the fact that it's been so gradual is not unusual. Some people have said, well, it's okay that unemployment's going up because it's in a very controlled and slow manner, unlike COVID when we woke up and we had unemployment of 12, 15%, almost overnight. But she says that's more the norm than not. But here's really a key quote. The Sahm Rule is currently sending the right cautionary message about the labor market, but the volume is too loud. I love that quote. She's saying that the trend and the Sahm Rule is still doing its job, warning a cautionary note and telling us to be careful, but it's not saying recession, it's saying be careful. So what does that mean for you and I? What does it mean to be careful, and how do we protect ourselves? I think it means a couple things. And the first one is making sure you have an emergency fund set up, right? As unemployment rate goes up, unfortunately what that means is ourselves, our neighbors, and our friends are at risk of losing our job. So ideally we'd have at least a 3 months worth of living expenses, preferably 6 to 12 months worth of living expenses in the bank, somewhere that's liquid, somewhere we can get our hands on it. We don't have to worry about it dropping 10, 20, 30%. If we were to lose our job and the economy goes bad and the stock market reacts negatively, right? So we want to have that dry powder so that we can sleep at night. We know we can weather the storm. So that's the first thing, is have an emergency fund. The second thing is make sure that your asset allocation, what percent of your portfolios in stocks and bonds, make sure that that's right. So if the stock market does go down 20%, 30%, 40%, you can withstand that mentally without it causing you to lose sleep. So much of success in life is about making good decisions. And on that note, that's why I made this video up here, which talks about why retiring at 65 might be a big mistake. Thanks for watching this one. I'll see you in that one.